Is a housing crisis, collapse, or correction coming? What other scary C word can you use? But is a housing collapse coming? I've got 3 data points that suggest you might want to put your seatbelt on. And in regards to the housing market, I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The housing market has absolutely skyrocketed over the past couple of years. It doesn't make sense. In Newton's law, what goes up must come down, and that's typically the case in financial markets too, that if something, tends to grow at this pace and all of a sudden does this, the hockey stick, as Kevin Korhorn would say, that's not natural. And eventually there will be some sort of correction coming. And following this time period where you couldn't even leave your house, let alone sell one, like we had that for a couple of months, and then all of a sudden these prices just skyrocketed. Houses were selling for insane prices, bidding wars, all that stuff. You lived through it. And guys, it appears that time might be coming to an end. And when it comes to an end, will it do so in a crash like we saw in the last financial crisis? So what's the data starting to tell us? Well, guys, whether it's a crisis, collapse, or just a normal sort of correction or cleansing, there's another C word for you. The data is telling us that it's starting, okay? For the first time in a decade, we saw housing prices drop in August. And you've got to imagine with what's happened with interest rates, that trend has likely continued in September. We'll get that data point here soon. But for the first time, if you look at this chart, for the first time since 2012, housing values actually dropped. Now, does that necessarily mean we are going to see a crisis, or is this just a normal, correction after such a steep increase? Time will tell, but there's data from Redfin, there's data from Zillow and from these other places. More and more people that have their house listed are having to reduce the price in order for it to sell. Houses are staying on the market a little bit longer, and overall values are starting to come down. Obviously connected with that is the other big trend in housing, and that is mortgage rates. Mortgage rates, guys, I'm not sure when you're seeing this, but just a couple weeks ago, were a little bit north of 6%. They skyrocketed to 7%. And I'm not sure by the time you're hearing this, by the time this airs, if they've gotten up to 8% or not, but they went right through 7% in one day and got up to 7.6% in just one day. Now, obviously, that's going to put pressure on house values and the housing market, and how quickly mortgage rates have come up has brought housing values, which went from high to ridiculously high, has now threatened their affordability. And when consumers are faced with that pressure, that's likely going to create some sort of adjustment, correction, drop in housing values. It also suggests that housing activity may be limited. I've talked about this before, but I actually heard my first real example of it this week, where someone said, I have a great job opportunity in another community where we would sell our house and buy one over there, and it's a job that I would like to do, and it's a place we'd like to live. However, I've got a 2.5% mortgage, and if I sell my house here at a 2.5% mortgage, my next mortgage would be over 7%. I'm not going to do it. And guys, that little activity, that shrinking, those decisions, right, will all take a toll on the overall housing market and what housing values are. But it all comes back to affordability, guys. And for prices to continue to be bid up, consumers need to be financially able to afford those higher prices and bid them up. Now, we printed $5 trillion within just a couple of months. That's been moving like honey throughout the economy and creating all sorts of distortions. And so banks have been willing to lend, credit scores and consumers have been strong, but we're starting to see some of the economic changes influencing the consumer, okay? And when you look at the monthly affordability, most people buy houses based on what they can afford by month. Now, I would argue that, and we've talked about this in other videos, that the higher the housing price, the bigger your down payment needs to be. And obviously that can influence how high prices can get and whether they're going to come down. But where the rubber meets the road is on your monthly payment. Now, if you take a $500,000 loan that was at 3% for 30 years, your monthly mortgage payment, not including escrow, not including insurance and property taxes, your monthly mortgage payment was around $2,100, okay, for principal and interest. Tack on property taxes and insurance on top of that. But a $500,000 loan at 3% for 30 years, around $2,100. If you got that same $500,000 loan at a 7% interest rate today for 30 years, your monthly payment is no longer $2,100, it's $3,300. Significant. That's not a rounding error. That is a significant gash in your monthly budget. Far beyond what you could probably just kind of round and just adapt to. That's a significant difference for the exact same size mortgage. So because most people look at their housing decisions based on what they can afford on a monthly basis, if you could afford that $2,100. Some of you can, some of you can't, but just follow this scenario. That $2,100, well then how much would your loan need to be to keep that payment the same? $317,000, $315,000. Instead of a $500,000, $315,000. Guys, that is an enormous change. And if you do that math, that represents a greater than 30% reduction in the value of that house, and therefore some could, and I've seen this in some circles, some are projecting the housing market could fall as high as 30% to get things back to affordability for the actual consumer. And that's on par, that's at levels consistent to what we saw in housing value reduction during the great financial crisis. Do we get to that level of crisis, guys? I sure hope not, and I'm not predicting that. However, with such a steep rise in a short time period for housing prices, I think it's likely we see a collapse, or a correction. I hope not a collapse, but it may be such a sudden shift as the marketplace adjusts to these higher interest rates and potentially combined with an economic slowdown and potentially rising unemployment. It's very possible we see a snapback of housing values back to something that's more realistic, okay? So what does this mean to you? If you were planning on making a housing decision in the near term, you've got to rethink and recalculate that decision with your certified financial planner. If you're not forced to make a housing change at this moment, I would encourage you not to do so. And finally, I'd resist the temptation to borrow up to what you think your house could be worth or appraised today, because if those values come down some, it obviously doesn't feel good when that happens, but it would feel the worst if you're all of a sudden upside down, which was the result of the subprime contagion, if you would call it that, right? So be wary of that. Work with your certified financial planner. Don't be emotionally tied to what you think your house is worth right now. Those prices could be adjusting and correcting. If you have any questions or will be making a big financial decision related to housing in the near future, work with your CFP. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.